don't gotta do it if you don't want to. You don't gotta do it if you don't want to. It's just a suggestion. Come on.
All right, you can start the show now. I'm sorry.
All right, we're gonna start. Welcome to the conversation. I am Psych, and joining me, as always, is letter K. We're going to continue our talk on money, finances, and today we're going to delve into investments, investing. So, cheers. Oh, and we're back to our Scotch from the Highlands single malt Scotch whiskey.
That stuff is legitimately Scotch.
Glenfarclas.
You sly dog.
So good.
Hey, before we start, I do want to say, we've been starting to see a little bit of traffic on YouTube, and I want to thank the people who are liking and subscribing. Thank you for joining us on the ground floor of our podcasts. We really appreciate the support. Hope you're enjoying the little shorts and the content. And also, if you're interested in watching the full-length podcasts, or if you're like me and you don't really want to watch the podcast on YouTube, we're also on Spotify and many other podcast applications on your cell phone and such. And if you prefer an app and you can't find us, let us know and we'll see what's up. But again, thank you. And yes, investing.
Yes, investing in one's future with money. Basically, when I was growing up, there was only my parents taught us there was four things you could do with money. You could spend it, you could save it, and you could invest it, and you can give it away. Those are the four things that I learned from my parents at an early age.
What other things could you do with it? Maybe set it on fire?
You could set it on fire, and
like the Joker.
Depending on how you set the money on fire, could actually end up falling into one of those four categories. For example, if you're going to make a video on YouTube of you setting $50,000 on fire in your driveway, well, that video might go viral, and that video might get monetized and actually make you that $50,000 back and more. So that might even be a way to invest.
That's like the old shell game thing where the guy's like, you got to have 20 to get 20.
Yeah. So, money can be complex, but when you break it down with just those four basic things that one can do with money: spend, save, invest, and give. Today we're going to talk about investing. And far too many people do not ever consider alternative ways of investing. Few people I have spoken with in the workplace have given investing a lot of thought. Anecdotally, many of the people somewhere in between 20 to 40, mostly 20 to 30, are a little less inclined to take steps to put money away.
Age-wise.
Yeah.
That's funny. Gallup disagrees with you.
Oh.
So according to a 2023 survey, roughly 58% of Americans have some form of stock. And this includes, of course, mutual funds, retirement accounts, probably mostly retirement accounts, I would say. Not a lot of people I don't know too many people who get into private stock investing. I mean, I do it, but it's mostly retirement accounts, EFTs and such. And it says that younger Americans, millennials and Gen Z, reportedly save and invest more aggressively than previous generations, often in response to economic uncertainty and rising costs.
Interesting.
Yeah.
Okay. So, of course, the sample size that I've come in contact with, staff that have come through my classroom, quite small, but it seems whenever the subject of money comes up, the people that I'm speaking with have far less information or far less knowledge about what options are available, how easy it can be, how you can automate things so it's quick and painless. You don't necessarily miss the money.
I think it might have something to do with, a lot has to do with your environment. I mean, so let me ask you this: the people that work for you and what you do, what's their education level?
The education that's required is a high school diploma or the equivalent, so a GED.
Okay. And it was the same for me when I was in groceries. You know, high school diploma is
Yeah.
all you needed to get into the grocery industry. Uh, and I had a similar experience where a lot of younger folk just were indifferent towards saving for the future. Investing wasn't even a word.
Mm-hmm.
So maybe that when we talk about millennials and Gen Z, maybe it's more the affluent people, the kids who've gotten the degrees, that they see the need to plan for their future,
Mm-hmm.
and maybe they have the opportunity to do that where other younger folk may not feel they have the opportunity.
Sure. I'm kind of curious, those that lived through 2008 and the housing crisis and the stock market tanking, or even not that far back, COVID-19, stock market just ate it, and
Took an absolute shit. Yeah,
people lost, but there was also many people that made a lot of money during that time too.
I did extremely well on both occasions.
Mhm.
And you're aware of this. So when you talk about investing, investing is obviously a risk, and there's ways to reduce that risk. Like during 2008, the housing bubble burst, and I worked with a lot of guys, older guys who had been putting into their 401ks forever, like store managers who were getting ready to retire. Uh, my grocery mentor Gary Schmier, he famously said, he had to stay in the business another year because he lost like $1 million in his 401k because the stock market completely took a dump, and it happened to a lot of people. Same thing in 2019. So one of the things about investing, especially with like retirement, I think that's a good place to start. Retirement investing, because it's so simple. Most workplaces nowadays have a mechanism in place for you to just easily divert some of your income into your retirement, 401k. For government people, 403b, or the other one you mentioned, 474,
457,
457.
but I'm still not clear on who that applies to.
But they're all available and they're easy to do.
Yes.
The whole era of the wage garnishment for the sake of doing that is you just type in a percentage in a website and it's just done.
Mm-hmm.
I meet so many people who think they can't save that money. They can't invest in their 401k. And it's one of those things where it's like, especially if your work matches, it's like I want to just stand up and backhand these people.
Yes. Many people don't recognize or don't know that many employers will match the money. Whatever you put in, up to a certain percentage that they will put in. So if you don't invest, they're leaving money on the table. Those people are losing money-wise because it's just extra money available to them. I mentioned the housing crisis and I mentioned COVID because I think maybe there's a certain level of distrust in investing because of the risk. I think some people are unsettled about it, especially if they had family members or close friends that were close to retirement or around those points in time, and they just lost their hat to a circumstance, right? Circumstances out of their control and outside of what, they just did not have any power at that time to affect any change when it came to their financial situation. And it was because of something as silly as a pandemic and a housing crisis.
So I think also too with investing in 401k and the stocks and the like, people get, this is obviously, the Great Depression was caused by a stock market crash. And it was because people freaked out. Same thing during these two events. People freaked out. Whereas the people, like when you have a 401k, you're kind of stuck, which is nice. You're watching it go down, but it's not like you can just sell all your stock and just get that money, like try to catch your losses. And so the thing about investing is with stocks, and I don't think people really understand, you're not purchasing a value, you're purchasing an item, and that item carries a value. So when your 401k goes from $1 million, and then there's this recession hits, or something dips, or you're privately investing and you've bought 500 shares of IBM or something, and something happens where that tanks, people are like, "Oh my gosh, I'm losing money. You got to sell it." One of the biggest things about investing is for me is patience and a little bit of nerve, because that's going to go back up. And I'll give you the perfect example. I was very fortunate. Um, I bought my house during the housing crash, and I never would have been able to afford a house otherwise, more than likely. But I got my house at a pretty good price when things were going down. And then I paid off my house during the pandemic. And again, and the reason I was able to do that was, guy I used to work with, he'd casually mentioned something about undervalued stocks, because when the pandemic hit, everything just dumped, like it was bad. And so talking about a little bit of nerve, I took all the money that I had been just saving, not investing, just saving in my savings account, and I bought 5 stocks that had totally taken a shit. Like they had just tanked, completely tanked. And I selected those stocks because I felt that the companies wouldn't fail. They would come out on the other side. And I sat on these for 2 years, watching them just kind of sit and go down. And there was all kinds of stuff. I got involved in the AMC ape thing, the whole bit. And at the end of those 2 years, when things started going back up, things started shooting back up because now they were undervalued. And I sold them and made so much money that I was able to just buy my house. So yes, have a little bit of nerve, but also you gotta know what you're looking at. You have to understand where your money is going. Just a little bit of research goes a long way.
Mhm.
And you can't panic at the
No.
first sight of downturn.
It can be a fun ride. It can be a fun
It's
ride.
yeah, it can be a little nerve wracking too when you because you're putting. So for most people, if you are investing, you are taking everything that you're not spending and you're putting it somewhere.
Mhm.
And so you're basically gambling your entire future on the decisions you're making.
Yes. Yes. So what's your philosophy when it comes to the aggressiveness that you choose to attack your retirement savings, your investing? I'll give you an example. So usually with 401ks or 403bs or any sort of a mutual fund or account like that, they have more conservative funds that you can put your
Yeah.
money into, and then they have more volatile, aggressive funds. What's your preference? Is it a blend between the two of them? Are you like right in the middle? Is it a happy medium? What's your take?
So I've always done for my 401k, I've always done the target retirement funds. And most of the companies have target retirement dates. So like you can be like, okay, I'm going to retire in 2037 or 2038. So I put my money into those. And then they actually, when you're younger, they're more aggressive. And then as you get older, they start to blend into a safer thing. And then by the end, they're like bonds and such.
Mhm.
So that's how I do my 401k. And that way it's a good set it and forget it kind of deal. With my Roth IRA, I set that to the highest risk and I just ride the wave. And that's interesting to watch
Mhm.
because like
The swings.
this huge swings. But my advice would be if you're young and it's going to go up and down. The stock market, the housing market, it goes like this, up and up, up and down, up and down, up and down. And so I say, if you're young and you're getting out, just put it into the highest risk stuff because it's always going to bounce back higher. The only way that you lose all of your money by doing that, because these investment companies, I mean, they call it the higher risk portfolio, but they're not putting your money into crazy shit that's just going to bankrupt you.
Mhm.
Ride the wave, have a little nerve, or just don't even look at it, and come back to it in 20 years, because you have the highest potential for earning at the higher risk, and you're going to be around long enough to let it go through several cycles.
Sure.
Yeah.
Sure. You also have to have enough money where you are comfortable enough to set it aside and never look at it again. That is the best advice. That's going to allow your money to grow. You're going to be less tempted to pull it out early or put it to use. Obviously, people who are struggling to put food on the table or put a roof over their head, investing is probably out of the question for people in that camp. Everyone should be taking care of their own survival before they enter into this realm of retirement savings and investments.
Yes, I mean, we talked about this last episode, where there is like a line on the staircase, and the people below the line, they don't really get to take part in this conversation, and it's sad to say there's many people that are like that.
Hopefully they will soon.
However, I think that the vast majority of people can invest, even in meager amounts. You don't realize just how much little amounts do. So I worked with a guy years ago, and he was trying to convince some of the young baggers to invest, start their 401k. He was like, the minimum is 3%. Just put in 3%. Like, oh, I can't afford 3%. And he took one of the baggers' paychecks. He's like, hey, because the managers hand out the checks. He's like, hey, do you mind if I just take a look at your check here? And whatever, go ahead, bro. So he looked at the guy's check and said, okay, for this week, you took home $100. This is 20 years ago. You took home $100. So 3% of that is $3. And this is a week. So you're telling me that you can't live without $3 in a week. It's basically the cost of buying a soda from the vending machine outside each day you work here. And if you think that that's too much money for you to save, or you can't afford it, I will buy you a soda every shift for a year to show you how much money you could be investing. Think about it. I saw another statistic recently where it was one of those things where it talked about growth over time, and it was like, one of the things was, if you read 20 pages a day, you're reading 30 books a year. It's ridiculous. And it also said, if you are saving $10 a day, you're saving $3,700 or $3,570, 365 days. Math, $3,650 a year. And so you can't save $10. So you can save $1 a day. It's just that $365, if you invest it at an annual return of 3 to 5%, is $370 next year. And then it's attached to the next $365 you add to that. And then the next year, that $800 is $840. It's just, people get into their head, oh, I can't afford this, but it doesn't take much. It's like the Acorns app. It's pennies on the dollar.
Yes, I think I equate investing much. I say investing is much like fitness, right? It's hard to get started for many people, but then once you start seeing the slightest results, it starts to get a little bit exciting, and then the results start coming in faster, and you get more and more and more, and you get this excitement builds, and then that's when you start seeing some growth. I also think I don't know if this particular class that my parents took when I was younger and they shared with us had this progression in there built in, but I was just thinking about, we talked about spending, saving, investing, giving, kind of that, but they're kind of in order, because if you don't have a job, if you don't have any income, you can't spend. So, and once you do get an income, once you do have some money, people typically go out and spend it first, until they have disposable money, or money that's not assigned anywhere, then they can begin to save. And you can't really start to invest until you start to save money. If you figure out, if you come to this place where I can live without this. I don't need this. I want to see what it can do. That's when that's the bridge to investment.
When I think about investing in your future, I think that you unless you're below that line on the stairs where you need every dollar just to get by, or you're not making enough to even get by. If you're above the line, I say figure it out. Find out how to live without that money.
Mm-hmm.
I mean, you're talking about 3%. 6% is very, very common. The Gallup poll said that the average person saves 5 to 10%, or invests 5 to 10%. And like I said, most of that is 401k. But you need to figure out how to live without that money.
Mm-hmm.
Just figure it out, because if you're like, well, I can't invest now, I'll start my investments later, or I'm just carpe diem, I'm living for the moment. You're going to be that old coot working in your 70s while everybody around you is retired, because you never put the pennies away when you had the opportunity. Back when you were even. I mean, I'm 46, and even now, if I started investing today, in 20 years, I could probably come up with some kind of a retirement plan. So think about starting to invest as a bagger at a supermarket when you're 19 and your company matches 401k at 3%.
Yeah.
You know?
That compounding interest and that time that a young employee has available is not something that they're going to be able to get back if they forfeit that moment, those moments, those years, that 3% or that 6%, that match, the compounding interest over time is really, when you lay it out like that, and if you can show somebody some real numbers and you can individualize it, if somebody has the wherewithal to meet with somebody in their family who knows a little bit about money and can point them in the right direction, or there's financial advisors out there, you can go into a bank, people can take a look at your numbers in your life and give you some real possibilities. They can see the potential. They can show you what your life could be like later financially if you make decisions now. But you have to be willing to do that. It's going to take a little bit of time and effort. You got to open some accounts. You got to make it happen, right? You have to give some information, and you have to automate things if you can. Almost all of our finances is electronic now. You've got direct deposit, putting things into your account. You've got your bank cards. You've got Apple Pay. You've got all this stuff. It's just electronic. It's automated. You just have to do it.
Yeah, and those automations make spending easier.
Yes.
However, they also make investing easier.
Correct.
I get direct deposit, and then I've got it all set up. It takes, like you said, it takes a little front end time, but I've got it all set up, and I invest static amounts monthly, and my investment company just pulls that money once a month out of my account, my checking account, and it's just ready to go.
Mm-hmm.
It's ready to go. So, yes, there's the I would say the excuse that I can't afford it is largely untrue. That it's too time consuming is impossibly untrue, because you can just have your investment go into a mutual fund or an EFT or something and just let it go and keep going, just forget about it. So what are those are the big excuses for me. I think time and expense.
Especially when you see somebody's history, their track record, their spending habits, and they're going out and buying luxury cups of coffee daily, or maybe multiple times per day. If they're eating out at lunch, on the job, 5 days a week, if they're going out to eat for dinner, if they're out at restaurants several times you can start to add all of these things up, and people want those things and they like those things and it makes them feel good in the moment, but it is somewhat short-sighted. But once they get started and they start to put money away and they can kind of see it grow, it's kind of amazing. I have a question for you. How many people, if you had to guess, population, United States, percentage, what percentage of people pull out money from their retirement savings early?
I would say it's probably pretty high. I know several people who have done it. I know several people who have done it more than once. And there are all kinds of laws surrounding that. But you can get out of all the tax liabilities by just claiming hardships and such. But if I had to guess, I would say it's probably at least 1 in 5.
1 in 5, so 20%.
Yeah.
It's actually a little bit higher. What I found today, about 30%. About 30% of the population.
Well,
and some of those instances might be necessary, right?
Yeah.
If there's a medical emergency and you have cancer and you need to afford these procedures and these medical bills, or you just bought a house and you can pull it out penalty free and you can get appliances or things that your household needs. If you and then the hardships, I mean, that just about anything can go into that category depending on how you word it. And I know during COVID, right, there was plenty of those hardships.
It was yeah. They deferred all of the payback penalties and stuff during COVID if you had to dig into retirement. I mean, but that's an outlier situation. Like, it's extreme. That is really some hardships. Yeah, I don't know. I don't know how, because it's that might be a part of the problem too. You start to see this money grow, and you're like, well, I'm broke as a joke, but I've got $184,000 in my 401k. What the hell's the deal with that?
Yeah.
Yeah.
It's tempting.
It's tempting.
It's tempting.
It's tempting because like, oh man, I could really use this new car, or yeah, I really like to trick out my home theater system or something.
Sure. So we have what, approaching 350 million people in the United States or something like that.
I think it's probably higher than that.
And then so you take the grown-ups, take all the adults. Well, you can only take the ones that are employed. And what do we say? Somewhere between 50 and 70% of the population has some sort of retirement, and then a third of them are pulling money, or 30% of them are pulling that money early. It's a little, what? It's not good. It could be better if that money were just allowed to grow and ride without being pulled and without being taken out of those funds. People would even appreciate and be even more grateful for the decision that they made. I've heard it put, try not to make decisions that are going to upset the older you, right? You in 5 or the you in 5 years, the you in 10 years. Try not to piss that guy off, right? Is that person going to be looking back at this person now and going, what was he doing? Why?
So as of November 2024, the estimated population of the U.S. is approximately 345 million people.
Okay.
Yeah, and that includes everybody living here. So how do you invest?
So, because I'm an educator, you don't really have a choice. The money gets pulled right out of my paycheck, because as an educator in California, I don't pay into Social Security. Because I'm not paying into Social Security, there's a pension plan set aside, CalSTRS. So it all goes into this investment fund that California is the custodian of, which, depending on how good California is taking care of that account, sometimes it can go like this, and that's a whole nother topic.
And that's job retirement. Do you do anything else aside from that to grow?
So I have acorns as well. I also have I've got a couple 403bs. The Roth. I want to highlight this. A Roth account. If anybody's going to get anything, okay, get your 401k first with the match and do that. If you can max it out, great. Most people can't. At least put in the match. And then after that, get a Roth account, because all of that money, all of the money you fund that account with, you've already paid taxes on. So after that fund grows, so let's say you put $10,000 in, and let's say that $10,000 grows into $100,000. because you already paid taxes on the $10,000 you put in, most people are unaware that when you pull that 100,000 out, there's no taxes on that. So you're paying the taxes up front to shelter yourself from all of the taxes in the future, which may or may not be higher. 401ks, taxes deferred, so you can save a little bit of money now, but everything you pull out later is going to be taxed. If you make $1 million in that 401k, a million worth of, it's going to be taxed at that. Every dollar of the $1 million is going to be taxed once you start to pull it out and utilize it.
Yeah. So yeah, I agree that the Roth IRA is a really good plan. And I would say get into it now, because there have been several plays to try and get rid of it.
Mm-hmm.
But they wouldn't be able to get rid of it for people who are grandfathered into it.
Sure. So my wife has a 401k at her job. Her company matches 6%. She puts in more than that. Then she also has a Roth. She puts in money into that every paycheck. I have, it's something ridiculous. So much money coming out of my check every month is going straight into that CalSTRS account, and it is matched. So whatever they pull out, there's a large amount that the district is also putting into that. And then, like I said, I have a couple 403bs and the Acorns with a Roth, and also the Roundup. So there's plenty of ways to do that. I also worked in the private sector long enough to get and be eligible for Social Security, but there's it's called the Windfall Act, I believe it is. Basically, it says, hey, for those of you who moved out of the private sector and are doing government work and haven't been putting into Social Security for a certain period of time, what would be your full Social Security is going to be greatly reduced as a result. And I think rightfully so. I haven't put in any money into Social Security the past 12 years. Yeah. So, and I know Social Security is a hot topic too. Is it going to be there? Is it not? Yeah. Or you're going to have to be 71 before you can retire, or not? And how much is it going to be? Is it going to be worth it? But I always advise people to never view Social Security as a retirement fund or an option to get them to retirement.
I think a lot of people in our generation and the generation before us do think Social Security is their retirement plan, and it's not intended to be such. It never was. When you talk about people living on a fixed income, they're talking about Social Security. It's not enough money, and it probably never will be. So yes, I think we need to reiterate the 401k matching. If your company matches your 401k and you're not putting in that minimum amount that they're matching percentage-wise, whether it's 1.5% or 3% or 6%, then you are leaving money on the table in the worst possible way. Think about it like this. If your company matches 3%, then you're getting a 3% raise simply by investing 3% yourself. It's like, it's a no-brainer. Mm-hmm. It's free money.
It is. I have a kind of an interesting story about that. I think I may have told you this. I'm pretty sure that I had. I used to work for a company that had a 401k match, and it was 3%. And that 3%, they were managing. However, the person that they had overseeing everything in HR at the time and all of the matches was matching 3% of what people were investing. So if they put in $100,
you get $3.
They were giving them $3 because that was 3% of the 100. Instead of, if that $100 was 3% or less, they should have been matching the 100.
They weren't matching 100% of the investment at 3%.
Yes. And it was this huge debacle, and it turned into a class action lawsuit, and people started to get kind of up in arms, like, what's going on? And if you screwed something up like this, what else have you done? And people started having their checks examined by private finance agencies and financial advisors, and it was just this uproar. But I say that to say you have to follow through and check your check. You have to view what's on there, go through it, line it. You have to be familiar with it. I think with direct deposit, it kind of takes that step out of the equation. Now you can forego it altogether. You don't have to look at your pay stub because you don't have to rip the check from it like people used to do and have to sign it and take it to a bank and deposit it. So if you are just accepting what your employer is giving you, they're human, they're fallible, they can make mistakes.
Perfect example. I used to do taxes for friends, and I had a friend who worked for a convenience store, and I did her taxes one year, and I was like, this doesn't look right just by looking at your W-2 or your W-4. And so I did her taxes, and I was like, hey, I need to see your last pay stub because you owe like $7,000, which is ridiculous.
Mm-hmm.
And so I look at her pay stub, and so long story short, it turns out her boss had screwed up the financial program he was using and was taking out almost no money in taxes. So none of the employees there paid taxes for an entire year. I think she paid 13 cents, and she had a coworker who paid like $1.09. And so the government was like, I need my money, you know? So yes, look at your paycheck. I am not the best at looking at my paycheck. Mine's pretty static, but I do maybe once a month. I'll download it and really give it an eyeball just to make sure that something goofy is not going on. Yes. Know where your money is going. And that goes back to me talking about just putting in a little bit of time to get the knowledge necessary. It doesn't take a whole lot. I know that for a lot of people, stock markets and things like that are extremely intimidating. It seems scary. All most people know about the stock market is that it crashed in the 20s and it ruined a generation of people. So it's not as scary as you think.
It can be done.
It can be done. And it can be done safely. It can be done safely and comfortably.
Yes. I was looking up some simple retirement strategies, and this is what I came up with. Start early, automate the savings, contribute to employer-sponsored plans, open an IRA or an IRA, set specific goals. I think that's a huge one. Set specific goals. What do they want? What do they want in the future? What do they want their lifestyle to be like? What type of means do they want to have? Are they going to travel? Are they going to, what's their education? Do they want to pay for their other kids or their grandkids? What are your goals? Increase contributions gradually. Cut unnecessary expenses. I think that's a hard one for people. Stay informed and diversify investments.
So cut unnecessary expenses. You had talked about all these things that people like to have, from coffee to pizza to all, we like to spend money. We're consumers.
Mm-hmm.
And so think about it like this. Remember I'd said, hey, if you save $10 a day, that's $3,650 a year.
Mm-hmm.
But it doesn't have to be so direct. How many people go out and get a $6 Starbucks coffee every single morning?
Yeah. Mm-hmm.
Can you eliminate that? And I mean, do all the other things you want to do. Go out to lunch. Live your life normally. Just find one thing that is something that you can personally be okay with eliminating, and just eliminate that one regular thing as an unnecessary expense. Take that money and invest it, and just do it. Do it. Make it a part of your personal culture, and just invest that $6, and you're going to be blown away.
Mm-hmm.
Put it into acorns. You can invest money in acorns.
Yes.
Yeah. Just or put it into, get yourself a Fidelity account or something like it, or Vanguard or something.
There's so many to choose
So
from.
many to
It
choose
doesn't
from.
really matter which one you use, as long as you get started. And if you don't like that account, if you don't like that bank, you can roll your money into a different account at a different bank.
And it's pretty easy. Like, even with investment companies, I had one company with the grocery industry and then another company with what I do now. And so I had two 401k accounts. And it was like a little bit of paperwork. I didn't have to get it notarized or nothing. Just had to kind of prove my identity.
Mhm.
And the one company sent a check to the other company, and suddenly my 401ks were combined. And so it's really easy to do if you're not happy with the service or something.
So I was talking about the fifth one that I mentioned with another friend of mine, and I was kind of asking the question. Well, I wasn't kind of. I asked the question. I was extremely direct. How much money are you saving for retirement? I wanted to know the number. This person's quite a few years my senior. I consider him to be a wise individual and financially frugal and knowledgeable. He's literate when it comes to finances. I asked him a number, and he came back to me with, "It's not a number that I'm looking for. It's a lifestyle." And then he proceeded to share the different things that he wanted to be able to do in retirement. And from there, I could kind of gather more or less about where he was going. But for you, what type of lifestyle do you want to fund after you stop working?
I'm living my best life right now, bro.
Okay. All right.
I don't need much.
Mic drop.
Yeah, I don't need much. We're not big on travel. I've always wanted to purchase a second home somewhere.
Martha's Vineyard.
Yeah, no. Well, but kind of somewhere in a sleepy little boutique vacation town, like a tourist town on the coast somewhere. And I looked into that for a while. I may not be able to find the barrier for entry for that kind of stuff is a little high for me, but I'm content to continue to enjoy the life that I have now. And I think that's really all you really can expect. If you can find a way to perpetually live your same life, if you're content with the life that you have as you're earning that ability to retire
Mhm.
and can continue that, I think that's a good goal to shoot for. I don't know. I mean, I know some people want to save so that they can do all kinds of crazy shit when they don't have to work,
Mhm.
and that's fine too. But I do stuff. I go on vacations. I enjoy my life,
Mhm.
and if I can continue to do that, I will be happy.
Okay.
I honestly think that we probably won't be able to spend money at the rate at which we're investing and growing our savings. So the wife and I, we have no kids, but the wife and I have this plan to create some kind of a Brewster's Millions kind of scavenger hunt for our fortune, and some random great nephew or niece, some dad way down the road is gonna get a video from me hooked up to a respirator. You're gonna find my fortune, and it's yours. And then, of course, the scavenger hunt continues. Yeah.
After they're traumatized by that picture of you on a respirator somewhere.
Hey, you know what? It'd be worth it to them for the free money. I mean, we won't make it free. We'll make it hard. But
You mentioned being content, and I think that's probably the thing that is the barrier for many people. They're content with their current life, and they're not imagining that level of contentment is not going to be the same in their 50s and 60s and 70s and 80s, because they're not going to have the ability to sustain themselves.
it's not just content. I think so many people are trying to constantly get more out of life that they feel like they need all of their monetary assets in order to achieve that. So yes, one, if you are living your best life right now and you're content with that life, but you're investing nothing, you're not going to be able to continue that life after you no longer work. So you're going to be working until you die. Two, if you're constantly trying to elevate yourself through consumption, through the spending of money, you'll crash and burn at some point anyway. You won't have the ability to maintain the increase by trying to chase the next great thing. Just put a little bit away. And I talk about how the stock market can be relatively safe and easy. I'll tell you how I invest. I have a 401k, but I also invest privately. Because I take the money that I don't spend on a mortgage and I put it towards private investments. And I engage in what are referred to as aristocrat stocks. Now, aristocrat stocks are stocks that produce a dividend, but they adhere to a set of rules. And the rules for that are that they have been giving a dividend every quarter for at least 25 years, and that their dividend payouts for every consecutive year have increased. So in my mind, if you're on the aristocrat stock list, and these are not huge returns, but they're dividends. You're looking at 3 to 5% annually against the value of the stocks that you're getting. So they're low volatility, they're lower risk, and after so many years of buying 1 share here, 2 shares there, 10 shares here, now I'm at the point where I just roll the dividends back into the stocks, and I'm buying more stocks that way now than I was when I started this 4 years ago.
Yeah, once you get that machine rolling,
Yeah.
then it can kind of take over. And if you have enough money in there, and your dividend payout could potentially at one point grow into what somebody's salary is.
Yes. And so talk about like matching your income as a supplement in retirement. I continue to roll the investments, and I will continue to do that until I retire. But then my plan would be to take the dividends and accept those as a cash payment and use that to supplement my retirement income. And so that's my plan when I talk about how you can invest in stocks in a way that isn't super scary or dangerous.
Mm-hmm.
And you're talking about, 25 years is a long time. So you're talking about companies like Coca-Cola and IBM, and there are a bunch of smaller companies, AT&T. There are companies like, I invest in a company called Enos, which is a paper manufacturing company. And so and do a little bit of research. There's several Reddits dedicated to aristocrat stocks, and people talk about it all the time.
What about IPOs? Have you ever jumped into any of the brand new, hot off the press, hyped stocks that are at the ground level? I know lots of people are thinking of these companies that we have now, the Facebooks, the Apples, the Googles. At their beginning, it would, if we had the wherewithal or the means at that particular time to put money into those things and just watch it grow exponentially, how amazing is that? I don't know if we have too many more gaps in the market where we're going to see those types of stocks take off and grow. But it could. Still, we've got AI coming out, and it's big and hyped, and that's what everyone's talking about. And maybe there are some of those companies that are going to head in that direction and just soar. But how about for you?
No, for initial purchase offerings, no, that is super high risk. Facebook, when they did the IPO for Facebook, a lot of people lost their shirts by buying at the IPO, and it didn't meet the expectations. So a lot of people found that their initial purchase was greatly reduced. They lost money on the deal. You're talking about mom and pop people, folk like us, just regular people. And for every Google, for every Amazon or Alphabet or whatever, they broke free from a pack of other companies. So we're talking about risky. This is how people IPOs are how people perceive the stock market. Like, okay, I've got these 10 companies. One of them is going to make me a millionaire. How do I choose? Yeah, no thanks. I don't do IPOs. If I decided that I had some money to bet on stuff, like when I go to Reno every year, I might do that. But that takes its own kind of dedication for research and understanding. I don't want to put the time into trying to learn stuff at that level. I'm not reading Wired. I'm not reading trade magazines. I'm not trying to learn what the next hot thing is so that I can invest in that hot new thing.
You're not looking to become an angel donor.
Not want to be an angel investor. I just want to take a percentage of my money and put it away at a frequency that allows it to grow into something that I can be happy with when I no longer want to work. that's my goal. And I think that should be the goal of most Americans. Don't get sucked into the hype of trying to get that big score or become the rich quick kind of stuff. Cryptocurrency is the same way. Yeah, crypto has the potential to really pad your pocketbooks, but it is such a high volatile and dangerous and difficult to understand and navigate environment. I think that for most people, just stay clear of that, and you know just think about your future at your content rate now. Don't try to get in. If you want to try and get rich, yeah, go for it.
So
This is not financial advice. Go fuck around and find out.
I've heard it put, and I tend to agree with this, that one should not put more than 1% of their annual earnings into the high risk, most volatile of investment options.
I could see that. I could do that, but then again, I still would want to spend the time to research and learn that, and I don't spend the time to do that.
Just treat it like gambling.
Yeah.
Like, is it going to work? It could be treated as a form of entertainment, like gambling is. Hey, I'm going to throw this money at this stock. It's less than 1% of my current income. I'm not going to be tempted by that. My lifestyle is not going to change drastically one way or another if this turns out to be a drastic loser, and I'm willing to accept whatever comes because of the potential if something happens, and I'd like to just see. I'd like to find out.
Yeah, I think that's great. If you have the money to do that, I think that's great, because that's where people start to think that, oh, the stock market is just a casino for the rich. That's what they're thinking about, because there is a lot of risk involved in the stock market. Don't get me wrong. Plenty of potential to lose everything in the stock market if you're playing games like that. But there are things like these aristocrats dividend stocks that
they're proven. They're tried and true.
Proven. They don't have that risk. The investment potential or the financial gain potential isn't crazy, but when you're talking about a nice steady growth, there it is. It's all ready for you. All I gotta do is not buy this soda from that machine or go to Starbucks and put that money somewhere where it makes you money.
So Kevin O'Leary doesn't put from Shark Tank. Mr. Wonderful. He does not invest in anything that doesn't pay him dividends. He doesn't own a stock. Or so he claims. He's unwilling to put money into stocks directly. Although, if I'm certain he's got various funds and things like that that are combined with stocks that don't pay out. But if he's looking at buying a stock, if he's looking at a company, if he wants to become a part owner and a part of their future, he's not willing to do that if they're not willing to pay dividends.
Either am I.
I think that's sound advice. It's hard to go wrong. It's hard to lose money. People don't want to lose money. The other side of that is people want the money fast. They want it quick. They want instant reward.
Yeah, it goes back to what I was saying. People want more. They see things like the stock market as a potential to get something for free. It's work. The investing can be work like anything else. You can minimize the amount of work, but you're never going to get something for free unless you're like lottery winner lucky, and you purchase an IPO at $1.40 a share, and it's the next Amazon.
So my oldest asked me one day on the drive. We're out with the family. We're on a drive, and he said, "Daddy, what would you do if you won the lottery?" And he was talking a lot of money, a lot of money. And I told him the first thing I would do is, knowing, and I've taught my boys this, that hey, people that, historically speaking, people that win the lottery lose all their lottery winnings within a few years.
I think the average expectancy of a winner is like 9 years.
Yes. So they know that, and they know that I'm not a fan of
being poor,
being broke and being poor and losing money at such a fast rate. Even though you do claim I am a super consumer,
I don't claim it. It's true,
and I do go through money because it's fun to spend. But anyway, that being said, I told him the first thing I would do was that I would hire a tax attorney. I would hire a tax attorney and I would get an accountant. And those are the first two things I would do. I would spend some of the money to buy good advice. Definitely the tax attorney, because they would be well versed in all of the tax implications on coming into such a large sum of money, and they would be well versed in how to shelter as much money as possible from taxes. And a tax attorney, a lot of people are like, well, I'll get an accountant. Thing is, with an accountant, let's say you made a gross error somewhere. Maybe you weren't trying to, but you did something wrong on your taxes, and now the government's coming after you. Your accountant can be subpoenaed, and they could be forced to testify and tell everything. Well, whereas with a tax attorney, there's attorney-client privilege, and their lips are sealed. So that's a great way to protect yourself if you happen to find yourself coming into a large sum of money.
You're no longer talking about investing. Now you're talking about winning the lottery.
But keeping that money so that you can invest it. If the government is taking the money in taxes, well, now you have less money available to invest. And I know a lot of people think playing the lottery is investing. It is not. I don't typically play.
It's a gamble.
It's fun money.
I played more of the lottery when I didn't like my job. But according to the National Endowment for Financial Education, about 70% of lottery winners lose or spend all their winnings within 5 years.
That is far too fast. Hopefully they enjoyed it. I wonder if we can run them through a happiness poll or a happiness survey and try to find out how many of them were pleased with their decision making.
You'd have to do that survey during the spending, because I guarantee you your results are going to be skewed if they're broke. Yeah,
True.
and like you said, spending, like all addictions, is fleeting happiness.
Is that what I have? I've been diagnosed right here in letter K, spending addiction.
Not medical advice, but yeah, it's true.
Seek help when appropriate.
Exactly. If you feel you have a problem, seek help where appropriate.
And try not to approach somebody with the same problem to have them clarify whether or not you actually have the problem they have.
Yeah, if you present a problem to somebody and they're like, oh man, me too, not the right person.
Yeah, not at all. What else can we say about investments?
We could go on forever, but I think we've hit it pretty good.
Do it if you can.
Yeah, just do it if you can.
It's kind of a little more wordy than Nike's.
Yeah,
just do it.
Just do it if you can. Yeah.
All right. Cheers. Thank you once again for joining us for this episode of The ConverSAYtion. Please check in next time. Don't forget to like, comment, subscribe, share, and thank you all for the support. And we are happy to see you next time. It's good.
It's all right.
It's all right.
Yeah. Oof.